Well, hello, and welcome to part 2 of our 3-part series called Proactive Tax Planning. And we're getting started right now. I'm John Williams, the owner and advisor at Ironwood Wealth Management. In part 1 of this series, I discussed some helpful information for filing your 2020 income taxes and some proactive tax planning ideas for 2021. Today, I'd like to share with you some of the tax law changes that President Biden proposed during his presidential campaign and what they could mean for you. There's so much information out there to digest, so our hope is to simplify it down to some of the key items that we feel our clients may want to be aware of. This is merely a non-political summary of what was discussed and is only intended for informational purposes. Please note that this workshop is not a substitute for using a tax professional. In addition, many states do not follow the same rules and computations as the federal income tax rules. As you know, I always think it's very important to review that there are 5 key areas of financial planning before I begin presentations like this. And those areas are preservation planning, retirement planning, tax planning, estate planning, and investment planning. Even though today's presentation is focused on tax planning, as a comprehensive wealth management firm, we try to always consider the impact of our recommendations not just on one of these areas, but on all of these areas for our clients. While these proposals are not yet law, it still could be helpful to be aware of them. So if they are considered, you can be better prepared. This video will look at some of those proposed changes. President Biden proposed increasing corporate tax rates. Under the Tax Cut and Jobs Act, the peak marginal corporate tax rate was reduced from 35% to 21%. Under the Biden tax plan, corporate tax rates would increase to 28%. Also proposed is an increase in the marginal tax rate for top earners, which were defined as individuals making over $400,000. Biden's tax plan would raise this top marginal income tax bracket from 37% to 39.6%. The Tax Cut and Jobs Act lowered the top marginal bracket from 39.6% to 37% in 2018. The proposal was non-specific, but here is a visual of what married filing jointly tax brackets might look like if this happens. Biden's proposal calls for lifting capital gains and dividend tax rates on filers with incomes above $1 million in income to pay ordinary tax rates on their dividends and capital gains, no matter how long those assets have been invested. This could mean that large earners or large gains could see those rates rise to 39.6%. Here is a visual of what capital gains tax rates could look like if this happens. Instead of 3 rates, there would be 4. Biden's tax plan includes a cap on itemized deductions of 28% for those with earnings more than $400,000. This means for each dollar of itemized tax deduction, like a charitable contribution, a taxpayer would only receive a maximum benefit of 28 cents. This 28% limit would hold true even if a filer is paying a higher marginal tax rate. For example, if this were enacted and you have $40,000 of deductions, then even in the highest brackets, you would only save 28%, or in this example, $11,200. Biden's tax plan would also phase out small business income deductions for taxable incomes over $400,000. This is a complicated piece of legislation, and his proposal did not share the details, but we still need to acknowledge it. Also proposed is the elimination of what is called the stepped-up basis at death. Stepped-up basis is a tax law that applies to estate transfers. When someone inherits assets, the IRS resets the asset's original cost to its value at the date of the inheritance. Many times, this is a big savings. For example, if an individual invested $300,000 in an investment that was worth $500,000 at the time of their death, their heir would only pay capital gains on anything over $500,000 if that investment were sold. This is because it receives a stepped-up basis. If this proposal becomes law, heirs would not inherit a stepped-up cost basis. They would inherit the original cost and pay taxes on the $200,000 of capital gains if they sold the investment. One of Biden's more talked about tax plan changes is to significantly reduce estate tax exemptions from the current $11.7 million per individual to $3.5 million per individual effective immediately. This means estates over that value would be subject to estate taxes. This is something those who have larger estates need to be aware of. I always find it interesting that Albert Einstein said years ago, the hardest thing to understand in the world is the income tax. And also, Will Rogers said, the difference between death and taxes is death doesn't get worse every time Congress meets. Moving on, Biden's proposed plan could change some tax laws with a focus on taxing corporations and higher income earners. With both the House and Senate controlled by the Democrats, Biden's proposed tax changes need to be watched carefully. As of now, tax change moves were not expected immediately, as the new administration has initially been focusing on getting the pandemic under control. We believe that taking a proactive approach is better than taking a reactive approach, especially regarding income tax strategies. If you have any questions, just give us a call. We would like to help others in 2021. In fact, we would be honored if you shared the names of a friend or two that we could forward this presentation to or add them to our mailing list so they can benefit from our ongoing valuable information. So what can you expect from us moving forward? Well, you can expect regular communication from us, more frequent discussions, and you can expect that we are continuously reviewing economic, tax, estate, and investment issues for our clients. Please remember, your health and well-being is always a high priority, and we always appreciate the opportunity to assist you with your financial needs. We want to thank you for watching part 2 of our 3-part series. Be sure to tune in for more information. We'll see you in part 3.